Welcome to this explainer. Today, we're literally pulling back the curtain on a really fascinating real-world case study. We're going to demystify the rigorous financial mechanics behind preparing a founder-owned business for a massive multi-million-dollar exit. It's a pretty stark look at what actually happens when you try to sell a company. Because honestly, it's not just about slapping a multiple on your revenue and calling it a day. It is entirely about building an ironclad, highly defensible financial architecture.
So here's our game plan for today. We'll start with the $20 million illusion, uncover the 5 deal-killing problems hiding underneath, look at how the financial architecture was actually fixed, break down the real exit math, and finally, give you the playbook for your own exit. Let's dive in.
All right, Section 1. The 20 million illusion. Was this really a straightforward exit?
$20 million. Now, we are looking at a 4-decades-old company here, jointly run by a founder and his son. And on paper, everything looked perfectly straightforward. They had real, tangible revenue, a super loyal customer base, and their ultimate prize was this target of $20 million. But here's the thing. Achieving a number like that requires absolutely flawless financial truth. When sophisticated private equity buyers are getting ready to hand over that kind of cash, they stress test literally every single assumption you make. If your story collapses, well, that $20 million vanishes into thin air.
So, to understand what happened, you have to look at the facade of the business. It turns out, this company was actually 2 completely separate entities that had never been properly consolidated. You had Entity 1, an industrial equipment modification and repair business, bringing in about $7.2 million in revenue. They'd buy heavy equipment and modify it. Then you had Entity 2, which was a specialty equipment rental business. Now, investment bankers were absolutely drooling over Entity 2 because of its highly profitable recurring revenue, but they were looking at it in a total vacuum, entirely missing the actual structural reality of how the enterprise operated.
That brings us to Section 2, 5 deal-killing problems.
Once the financial experts finally lifted the hood, they found these massive, murky financial gray areas. Now, to be clear, there was absolutely no fraud going on here. But there were 5 major blind spots that would send any private equity buyer running for the hills. We're talking double-counted revenue, fictitious year-end CPA tax plugs, completely misallocated overhead, balance sheet assets marked at a big fat 0, and an absolute lack of a consolidated financial view. Think about it from a buyer's perspective. During due diligence, they see this and immediately think, well, if they got this stuff wrong, what else is hiding in here? And just like that, the deal dies. Let's talk about the absolute worst offender of the bunch. $1.6 million. That's the amount of phantom, double-counted revenue they discovered in the business. How does that even happen? Well, they were running 2 non-integrated accounting systems. So for a lot of their sales, equipment builds were being booked as an internal sale in one system and an internal cost in the other. If a buyer's due diligence team comes in on day 1, runs a revenue bridge, and finds $1.6 million of completely unexplained revenue inflation with 0 net income impact, the deal collapses on the spot. No questions asked.
And this overhead situation is just as crazy. Remember how I said the bankers loved the profitability of Entity 2? Well, Entity 2 only looked artificially profitable because literally 100% of the enterprise's payroll and overhead was dumped into Entity 1. Entity 2 was basically getting a free ride on paper. You just can't sell a business to institutional buyers based on highly skewed metrics like that.
Then you have the tax strategy issue. The business was running on cash-based books that were completely driven by tax strategies, which totally masked true profitability. In one specific instance, their CPA made a year-end plug that included a $500,000 fictitious expense. It literally didn't exist, but it was placed there strictly for tax purposes, artificially understating the company's net income by $500,000. Private equity buyers simply cannot and will not buy businesses that run their books solely to lower their tax bill.
So what do we do about all this? Section 3, fixing the financial architecture.
How do you actually save a deal that's this tangled up? This is where our fractional CFO team stepped in and ran a 5-month sprint to put the truth in defensible black and white. They ran a tight, sequential playbook. Step 1. They set up 2 separate tracks. The CPA could keep doing tax adjustments while the team upgraded the company's actual books to strict GAAP accrual standards. Step 2. Institute proper intercompany pricing and allocate overhead fairly based on actual labor and revenue. Step 3. Build entirely new fixed asset schedules from scratch. And finally, Step 4. Bring the whole shebang together into one clean, consolidated financial view.
Now, you might be thinking, okay, fixing enterprise blind spots across 2 ERP systems, that's got to require some massive million-dollar software integration. Nope, not at all. The team just implemented solid standard operating procedures and used a simple off-the-shelf software tool called Analytics. And get this, it costs exactly $23 a month. That simple tool successfully combined those 2 separate ERPs into one consolidated financial view, allowing buyers to see exactly how cash and profits were truly generated. It is such a great reminder that proper process matters way more than expensive tech.
Okay, let's look at the payoff. Section 4, the exit math revealed.
So how did all these operational fixes actually translate into the final valuation? The math here is incredibly fascinating. By properly consolidating the business, they were able to show about $3.4 million in EBITDA, which gave the operating business a value of roughly $17 to $20 million. But wait, look at that middle row, the asset premium. Remember how the CPA was running those fixed asset schedules strictly for tax purposes? Because of that, 40 to 50 heavy machines were fully depreciated on the books, literally marked at a value of 0. But in reality, heavy equipment has a huge residual value. When they did a proper market check, they uncovered $6 to $7 million in hidden asset value that was completely invisible before the cleanup.
And because they finally had clean data, the whole story evolved. It was no longer just some pitch about a profitable rental company. Instead, the new narrative presented a vertically integrated industrial platform. Think about it. The business built its own assets, deployed them for recurring rental income, and then eventually exited them at a gain. Zero margin leakage to third parties. That strategic premium is exactly the kind of thing sophisticated buyers will pay absolutely top dollar for, because it signals tremendous operational control and stability.
Which brings us to our final section, Section 5, your own exit playbook.
So, for all the founder, owners, and business leaders watching this right now, how do you apply this case study to your own future exit? Well, it takes deep discipline and a lot of patience. Don't jump the gun here. 24 months out, figure out your absolute walkaway after-tax number. 12 months out, take the time, just like the 5 months in our case study, to completely fix your business and financial architecture. 6 months out, build a bulletproof data room filled with GAAP financials, working capital analysis, and rock-solid operational data. Only at 0 months out do you actually engage buyers. Never ever fall for the private equity marketing machines that want you to hand over your info before your house is completely in order.
I absolutely love this quote from our source material because it perfectly captures the entire philosophy we've been talking about. The numbers are the evidence, and the story is what the investors buy. It's so true, right? You literally cannot have one without the other. Your 3 to 5 year vision for the company has to be specific, it has to be believable, and it has to be grounded in flawlessly organized historical data. Because if the story collapses under scrutiny, the buyer walks, every single time. So I want to leave you with this final provocative thought. The true benchmark of financial preparation for a founder-owned business is speed and accuracy. If a top-tier buyer knocked on your door today and asked for full comprehensive due diligence in less than 48 hours, honestly, is your business ready? If the answer is no, well, you've got some work to do. Thank you so much for joining me on this explainer. I really hope this empowers you to take complete control of your financial architecture and start preparing for your own massive exit.